All right. Hi, everybody. Thank you for joining us on this panel. We're going to be talking about tokenization, real-world assets. I'm sure you had a great intro just now to all of that. I'm joined by some really great people, but I'll let them introduce themselves. How about you start, Duncan?
Sure. So I'm Duncan Moyer from Aberdeen. We're a global asset manager, and I lead the digital asset strategy of the company.
Good afternoon, everyone. Simon Barnby from Archax. Archax is an FCA-regulated digital asset exchange, broker, and custodian.
Such a booming voice. I'm Morgan Krupetsky. I run institutional business development at Avalabs. Avalabs is a for-profit software company building infrastructure and tooling to really drive forward the growth and adoption of the Avalanche blockchain.
Jürgen from Taurus. Hi, everyone. For those that don't know Taurus, we're an infrastructure provider for digital asset custody and tokenization. End-to-end, really, hosting nodes and so on. My role is on the partnership side, leading the strategy globally.
Great. To start off, I guess, for those who are in the room who may not be familiar, Morgan, do you want to give us a rundown of what you would define as tokenization, or define as a real-world asset, I guess, in this sense?
Sure. So, well, from a tokenization standpoint, you could just think about the idea of tokenizing something as creating a digital representation of it on a distributed ledger, often referred to as a blockchain. The assets that can be tokenized can be everything from financial assets like equities and fixed income, all the way to physical assets like commodities, wine, and even ideas and information like IP. And digital identity and kind of everything in between. So the idea and the concept is pretty broad-based. When we talk with a lot of financial services institutions, in the first instance, it is kind of a focus on financial assets. And so far, the more crypto-native community's best term for it is RWAs, real-world assets. But that's generally what we're referring to.
Yeah, you were saying earlier you prefer off-chain assets.
Yeah, just because among like regulated buy and sell side institutions, and a lot of this audience probably knows RWAs refers to risk-weighted assets in the more traditional world, and so the idea doesn't necessarily resonate from like a label perspective, but generally we've been referring to the idea of tokenizing off-chain assets and kind of bringing them on-chain. And
we're quite lucky because we have two people here today who actually work together on tokenizing real-world assets from Archax and Aberdeen. Simon, from Archax's perspective, what do you think tokenization looks like right now? Where is the market at in its journey and the evolution of that?
Yeah, I mean, it's full disclosure. Aberdeen are an investor in Archax, and we're working together on several projects. But it's been an interesting journey because I think, as Katie touched on the way on her intro, every year has been, this is the year of tokenization. This is the year when asset tokenization is really going to take off, and clearly that year hasn't really come yet. But I think it is beginning to change now, and and I think actually the work we've done with Aberdeen and Aberdeen investing in us, and then work we're doing with other asset managers and large financial institutions just kind of shows that there is a change, there is some momentum building, and it feels like there is a shift. And I think every other year that people have talked about, this is the year of digital securities or security tokens or whatever they were called at the time. It was kind of more of a people willing that to be the case rather than any sign that it really was the case. The technology has been there for some time. It's just the real thing that was going to change was kind of institutional adoption, or a move from the institutional side of things to get involved in the tokenization space. And that takes time. As soon as institutions are involved, regulation kicks in, so you have to have clarity around regulation, at least in one jurisdiction where some traction can be gained. And institutions are slow moving because they're regulated entities and they have to be sure about what they're doing. So I think there is a genuine shift now. And I actually fund tokenization, certainly from our perspective. I mean, we're kind of cross-asset. We're not aligned to any particular underlying asset for tokenization. But fund tokenization certainly seems, for us at the moment, to be one of the ones that's gaining real traction and momentum and seems to be a focus of interest institutionally right now. So.
And I mean, as an example of that, Duncan, why don't you tell us what you're doing at Aberdeen to wrap all this tokenization stuff into your business?
Yeah, so I guess we've been working on tokenization for a few years with Archax, so it has taken some time, and it's a bit of a phased approach, starting with Archax tokenizing their interests in our money market funds, and then being able to offer that externally, and then hopefully with more kind of products in the pipeline there, and then working towards a full, I guess, securitization. So for regulated tokenized securities on funds, which is a bit of a more complex operating model, so it takes a bit more time. You have to work with more traditional service providers to get that over the line, and that takes time. And then, that then leads on to individual assets after that. So this is kind of the phased approach we have.
And where do you say you're at in your journey? Like, how much more do you think there is to go for Aberdeen in tokenization?
Oh, loads. I mean, look, we've got money market funds available, right? So there's just so much more. There's much more you can do. The tokenization part is the kind of like the easy bit. It's everything else around that, and you need to make. There's no good just tokenizing a ton of assets and then not thinking about the distribution channels. So there's so much more that needs to be done around the edges to make it, to kind of bring it to life. So we've got a long way to go.
And Jürgen, you were saying earlier about how the impact of the last 18 months has been quite drastic for some businesses. How have you seen demand from clients or clients coming to Taurus? How has that changed for you as a result?
Yeah, I mean, if I compare it to about 18 months ago, where everything we have seen most of the use cases from institutional clients, i.e. banks, was around crypto, staking, see how they can put together a business case as well and get approval for it internally. Really to a shift completely into the tokenization space, where you see probably 80%, 90% of the engagements or the discussions we're having now is around tokenization use cases. So custody aspect doesn't go away, but it's really the shift from, okay, let's look into the space, because there's really opportunity. I think Simon alluded to it. There is always kind of like this, coming up, because crypto went down, should we now focus on tokenization? And once the bull market kicks in, we go back again to crypto. I think what also changed is the environment on the interest side. Interest rates have gone up, which means discussions we're having around stable coins, deposit tokens with banks, that becomes more meaningful, because if you have, let's say, T+2 settlement, because there's obviously no DVP settlement, right? If it's T+2, you have a lot of liquidity trap. So in this cash lag, putting that on chain, there's something where if banks work through it, I think there is a efficiency gain to be had, and that's, I think, is a changer now as well. Because other than that, tokenization was there before. It's just how can you find fit within the banks, and that's, look, we're working with approximately 30 banking clients globally, and they see. So you mentioned funds. From our side, it can be equity, it can be debt. I think we don't have seen not a killer use case yet, but there is a lot of traction to it. Many of the things probably behind the scenes, and more announcements coming out. But there's absolutely that the technology behind it is not going to go away, and tokenization is a new means of really building up and building this out for next years to come.
Yeah. And Morgan, where would you say the demand for tokenization is coming from in terms of sectors? Is it coming from banks, asset managers? Is it coming from crypto? Like, where would you say that demand stems?
Well, I think there's a difference between the demand to operationalize it as a use case and the demand for the underlying asset. On the former, to what you were saying, you're getting large majority of not only the traditional institutions that we speak with, banks and asset managers, but also a lot of more kind of crypto-native individual teams who have come from the financial services industry, now pursuing different types of asset tokenization protocols. We're seeing a lot of that. And we're seeing a lot of interest really kind of across the spectrum in terms of liquidity and types of assets. Generally speaking, in the first instance, either on cash and cash equivalents, and then on the other end of the spectrum, more alternative and illiquid assets, private equity, credit, infrastructure, and real estate. And that's, generally speaking, where a lot of the financial institutions are focused, largely because those are the most operationally intensive, least standardized assets that are set to benefit the most in the first instance from putting certain aspects around fund admin, reporting, accounting on-chain. And that's therefore where a lot of people in the first instance are focused. When you talk about the demand for the underlying assets, I think that's a different story. And I think, and Duncan, we were talking about this the other day in terms of where the demand is coming for your tokenized money market funds. I think in the first instance, when you talk about more liquid assets, money market funds, T-bills, the go-to-market strategy for a lot of institutions and individual teams has been really focused on the more crypto-native community, DAOs and protocol treasuries. And I think that, there's certain kind of hurdles around that, which we can definitely kind of go into, but I think that's where we've seen the demand kind of pop up in the first instance. But I think generally speaking, when you're talking about demand, I mean, blockchain and tokenization is just a really boring but updated wrapper in terms of accessing a specific asset. So I think for a retail investor, accredited investor, or even qualified purchaser, the idea should be that they're being given access to a totally new and novel asset class that potentially they don't have access to otherwise with lower investment minimums. And tokenization and blockchain just happens to be the means by which they're able to access that thing. So again, a really boring concept, but it should be kind of like a gateway to enabling a lot of individual accredited investors in emerging markets to have access to things that potentially historically they haven't had access to.
And Duncan, would you say that's where you're trying to get to with Aberdeen and putting your projects on chain? Is it getting to retail or to those professional individuals?
Yeah, I mean, I would say anything from smaller institutional down, because it's not just the retail that miss out on the big opportunities in, let's say, private markets. If you look at even the multi-billion-dollar institutional investors, their private market allocations are generally very, very small, particularly if they're, let's say, an endowment or a public plan or an investor like that. So that there is a gap, I think, in the market that's not being met today. But that's not to say there aren't benefits for the largest institutional investors. I think if you, we talk about all these assets that are going to be tokenized, they got to come from somewhere. And it's the asset owners today are the big institutional investors. If they're going to tokenize and fractionalize their investments, they're going to get a liquidity benefit, but they're also going to expect a yield pickup, right, from those fractionalized investments. So there are opportunities across the spectrum of investor type. But yeah, this is the story. This is what we're in it for.
And Simon, how many kind of corporates are thinking about tokenization in this way? Are they thinking about doing things that aren't financial, things that are financial? What are you kind of seeing at Archax in terms of inbounds like that?
Yeah, I mean, I think it's a little bit split, and it goes a little bit back to what Morgan was saying. At the end of the day, this is just a new technology. A security whose record of ownership is stored in a spreadsheet is pretty much the same as a security whose record of ownership is stored on a blockchain. It's just stored in a different place. So in some respects, there's nothing new, and taking traditional assets and creating digital representations of them, so what? Well, there's all sorts of benefits that can come from it, particularly efficiency gains. And if you look at the equity marketplace, the post-trade world is hugely inefficient. There's lots of intermediaries. Everyone's got their own books and records. You end up lots of discrepancies. There's reconciliation. So the technology can deliver huge benefits of efficiency to existing traditional off-chain assets by bringing them on. And I think institutions are really interested in that because that will take some time to build traction. It'll take some regulations to evolve to realize some of the benefits, particularly in post-trade, but that's hugely exciting. Anything that saves institutions money is hugely exciting. And then you've got kind of the other side, which is the technology is also being used to create innovative new instruments. And Bitcoin was the first and great example of an innovative new instrument. But there's lots of others. I mean, for example, we're working on some regulated tokens, so they look like securities. They're regulated like securities. They have an ISIN code, but they give you direct exposure to ETH or other proof-of-stake yields. So, you know, I think there's a variety of things. I think for institutions to get interested in that sort of far end, the cryptocurrency side of things, those that are in are probably still in, but those that aren't in are not getting in yet because, you know, the market's been, you know, over the last 18 months, it's been a roller coaster ride, and so people who aren't involved have taken a step back, and people who are involved are being pretty cautious. And you've got the left-hand end, which is kind of the efficiency gains and like the work we're doing with Aberdeen, Duncan Aberdeen on the money market fund, opening it up to a new potential investor base. That's hugely exciting and interesting. And then you've got that kind of middle ground, which is sort of giving crypto exposure through regulated instruments to institutions. That is interesting too, but it's probably only interesting initially to those that understand the crypto world, that can see the benefits that they want to get exposure to through a regulated instrument. So I think it depends on, you know, which part of the tokenization journey you're talking about, but there is institutional interest in each. It's just for different reasons for different institutional players.
Yeah, I mean, you acknowledged the period that we're in at the minute. You know, in the last bear market, there was a big focus on blockchain, not Bitcoin. It was kind of the way that investors who were already in the market kind of rationalized away what was happening with prices and potential losses in that area. Is tokenization and real-world assets kind of the buzzword of this bear market, Jürgen? What do you think of that kind of development and this sudden focus on this area where there wasn't really a big focus before?
Yeah, maybe just one point to add to Simon's comments is about the inclusion and the expansion of investor base. I think it's especially important when you think about private markets. So we have done projects, and that's now Swiss specific, but we have done projects with companies that have a big community, want to build something new and want to raise some equity. Now, going out there, listing it somewhere in a stock exchange is very expensive, right? But you can reach your investors, you can get new investors by actually using tokenization as a means, going to a marketplace and doing the book running there. And they were able to raise quite a significant amount of money to fund their project. So I think there is a lot to it when you think through, and I think the more we move on, the more of those projects we will see. Depends on the countries as well, because some are more advanced when it comes to regulatory aspect. So that is one. To your other question around the tokenization side. I mean, an interesting thing that that we have seen is really, if you think about it, bull market, you have a lot of projects that are suddenly cropping up from everywhere. Everybody gets really excited about different things, money is being thrown at. When it comes to the bear market, many of these projects disappear again. But the ones that stay are the ones that initially, where the business case adds up. And now, you know, talking about engagements we have with financial institutions, that some of them had to pivot as well. As I mentioned before, you know, their business case was around crypto buy and hold and staking. At some point, you know, top management said, sorry, we can't really support that anymore. The ones that looked at tokenization of assets, of funds, of debt, and so on, these ones, they still see them through. So even though we have a bear market, maybe the investments are not there, but these projects still get funding, and that's what we're working on, and that's what they're working through as well. So it's good to see. You know, look, as I said in the outset, it's not going to go away, and it's really, the technology is there to stay, because it makes things more efficient, and it's just about finding the right business case as well for it.
I mean, Morgan, what would you say to that, the idea of, you know, like, when FTX collapsed, when everything was happening last summer, a lot of people came out of the woodwork saying, well, okay, so now it's time to build. We're going to spend this time building. Is this the fruition of that? Is this how we're seeing people build, and this is the next technology for bull markets to come?
So I started Ava Labs 4 days before Terra happened. So my timing was impeccable. And before that, I worked at Citi for 12 years. And so I came into this role thinking, you know, this is going to take forever in terms of pulling institutions along. I'm going to have to sit there and explain the merits of blockchain. And especially after FTX, I will say I've actually been extremely pleasantly surprised by how progressive those institutions who've you know, become public about being progressive in this space, how despite, you know, the developments in the crypto market over the past 18 months, how they've continued to forge ahead with their initiatives and do a lot of internal and external stakeholder education about how there is a difference between kind of the developments over the 18 months and the underlying capabilities of the technology. And why this is different, and maybe it might be a version of blockchain, not Bitcoin, but a lot of them are looking at it from a business-first perspective, where they think about their pain points in their day-to-day businesses, their strategic priorities, and kind of their client base and their core services, and then taking a use case-first approach to, can blockchain and tokenization / smart contract logic address these pain points and drive forward these business imperatives. So, in that sense, I've been, again, extremely pleasantly surprised with how, despite everything that's been happening, we've been seeing these institutions forge ahead. And obviously, it doesn't take overnight, and a lot of them have been at it for many, many years now. But it's great to finally see things kind of coming to fruition. And I think part of the reason why, quote unquote, this time is different, there's a lot of reasons, but I think part of it is you're finally starting to see major C-suite executives from buy and sell side firms touting the future is tokenization, and really kind of driving the space forward in that sense. Plus, you have the advent of DeFi and all that brings from a composability and programmability perspective, which, despite the fact that tokenization isn't a new concept, the kind of capabilities of DeFi really kind of allowed people to kind of visualize greater utility over some of these assets on chain.
I mean, Simon, would you say that DeFi is something that traditional institutions are interested in? We've seen tokenization plays from banks like Citi, but it's been, tokenizing their own deposits, not necessarily been embracing everything that crypto is. How much of the trends at the minute that we see are really true crypto trends, or is it just versions of that banks are comfortable with?
Yeah, as with all these things, I think you have to define what you mean by DeFi. I mean, is DeFi distributed finance or decentralized finance? It's kind of, you have to define what the term is maybe. I mean, certainly I think in my mind, and I think also institutions is a pretty broad term, and it kind of gets used for everyone from an individual professional investor up to one of the large sort of global investment banks and everyone in between. And certainly at one end you've got the hedge funds and maybe people who have more control of money and can make operating in the alternative asset space who will get involved in things earlier and try things out, and maybe kind of the DeFi world where we're seeing things like borrowing, lending, staking, yield, and all those things going on. I think that is of interest to that portion of the sort of institutional world. But at the other end, then it's so far away from a focus for them right now, and that's partly because of regulation. I think innovation is always ahead of regulation, and what's been happening in DeFi is hugely exciting and hugely innovative. But the regulator is yet to catch up, and I'm sure some things in DeFi probably should be regulated, and at some point the regulator will catch up and start to regulate them. Now I know there are people, in fact, we're doing it too. We're looking at DeFi and looking at how can we leverage some of those exciting, pioneering things, but in an institutional, regulated way. And I think when things like that begin to happen, then you'll get sort of a broader interest from this sort of the overall institutional world.
That's something actually. So we found that really resonates with a lot of our financial institutional partners of using DeFi applications, but in a way that facilitates traditional assets and kind of upgrading legacy infrastructure and institutional ways of working. So maybe forking some of the open source protocols out there and making them more institutional grade. It's something that we call on-chain finance, or OnFi. Feel free to use that.
No, another one.
OnFi. But it's a way that I think a lot of institutions have kind of, for lack of a better term, wrapped their minds around. I can use this tech, but in a way that is still abiding by the laws, rules, and regulations that I need to, but in a way that still helps to create these efficiencies, unlock historically locked capital, collateral, all these things that you can actually use the tech for, but in the context of your traditional business.
I mean, so yeah, that kind of brings me to my next question. I think the big debate with tokenization is permissionless versus private chains. Mostly we've seen bigger institutions, traditional institutions, get involved in the private side of things. It's something that they can control. But we're now starting to see some move on to networks like Ethereum. I mean, Duncan at Aberdeen, where are you at in that level of comfort? Are you happy going fully permissionless, or is it still a journey for you?
Yeah, so we made a a decision at the start when we started this that the future would be on public blockchain, and so we started working with Hedera Hashgraph, but it's a public permissioned deal. It's a DLT. So for us, that was the right mix of having giving the public part, giving the potential scale in the future, but having a governance framework that we felt would resonate really well with, well, our risk committees and board, and the groups that we were going to interact with. So that's the kind of area that we want to be in. But yeah, I mean, in the future, I think with the right safeguards, permissionless could be it. I would love to see our funds tokenized and traded through a DEX. Because if you look at traditional finance, retail increasingly makes up a bigger proportion of assets traded, and I think that world, like decentralized exchanges, work very well with individual investors. And if you want to have the biggest scale and potential for your offerings, this is where we need that. That's an additional part of liquidity that will make it a reality. We just need to have the right kind of controls in place to make sure we can do it within regulation.
And I think also, if you think back to the post-trade space where we said there's all sorts of huge efficiency gains for the market as a whole, in the post-trade space, if everyone's got their siloed blockchain or their siloed permissioned owned technology, that's never going to happen. Unless you have some kind of common interoperable solution, you're not going to get those post-trade gains, which is what is quite exciting. So.
Yeah, I mean, Jürgen, how are you navigating those conversations?
Yeah, it's a bit like you don't want to have fragmentation of markets again, right? You fragment all the markets, you want to be inclusive, and yet you work in different pockets. How do we do that? Well, like from our perspective, we're agnostic to what clients want, but what we have seen from a client base is, yes, everybody starts off private, so it's good actually to hear from Duncan then that public was what they be a bit in a smaller framework, but that's what you want to go for. So the private side is what's predominantly there, but more and more looking into public blockchains as well. Just because, as time moves on, risk teams get more comfortable with it, compliance team gets more comfortable with it, and more importantly, regulators get more comfortable with it as well, right? This whole thing is an educational journey. You can't just change an industry. It's a transformational journey, so you can't just change the industry by saying like, okay, this is the new world and that's how it is, because everyone else around you will say, no, we have done it that way and that has worked, and that's true, and kind of like what we have seen in last year with many companies blowing up, just strengthens the position on the traditional side to say like, well, we did this since 100 years, why would we change something? And everybody runs around. So it takes time, but my sense is, and what we've seen, there will be a shift away from just doing own pockets of little POCs and little announcements to be more inclusive. And I think, look, that's my personal opinion, I think it's the right way to go, but it will take time. You can't just do it from one
I think part of that also is X amount of years ago, the only options were public permissionless and private permissioned and nothing in between. And over time, we've now seen hybrid solutions and chains come up that kind of offer the best of both. And in speaking with a lot of institutions, I think a lot of them, to your point, Duncan, foresee a target state in some way benefiting from public blockchain infrastructure and development, DeFi innovation, native integrations, but that doesn't necessarily mean that they can therefore obfuscate the laws, rules, and regulations that they're governed by. So now we have these hybrid solutions that enable them to kind of get the best of both in that way. And then in addition, there's multiple levels when you talk about permissioning, there's also multiple levels of permissioning. So just because you put a security on chain doesn't mean now you can't follow security, or doesn't have to follow securities laws. So you can still implement permissioning, whether at the wallet level, the token level, the blockchain level, multiple levels, to still kind of technologically manifest that kind of compliance, that compliance rule within the context of the on-chain asset, but in a way that still kind of follows broader public permissionless chains writ large.
And if we think about this from a crypto perspective, probably most of what we've been talking about now is trying to answer the questions for institutions in the traditional space. But if we think about it from the crypto perspective, a lot of what we've seen in tokenization is things like treasury management. Platforms like Maker buying up hundreds of billions of dollars in US treasuries, but tokenizing them so they're still accessible. I mean, if we get into another bull market and those yields that we saw last year in DeFi return, we've had a question on this from the audience, do you think that those opportunities for tokenization that we see now are going to fade in demand, or do you think they're going to remain? I mean, Simon, what do you think?
Well, I'd be interested to hear what Duncan thinks.
But
no, you come to me. Yeah, I mean, ultimately, I think all these different instruments always have a place. It's just sometimes one comes to the fore because of prevailing market conditions over others. So, there may be ebbs and flows around where the level of interest is. So, maybe as things change and the interest rates come down and the DeFi yield looks, really attractive again, maybe things will change. But it does come back to what we were saying earlier, is that, for institutions to get involved in DeFi, a lot has got to change. I mean, okay, for some, they're involved already, but for the mainstream institution, it's quite a challenge. I mean, Duncan, what do you think?
Yeah, are you going to be investing in DeFi protocols one day?
Maybe one day. But I mean, I work at an asset manager. I think probably within financial services, asset managers have kind of felt the rise in interest rates, the hardest. As investors want to move assets out of risk assets into money market funds, I guess largely in deposits, and I don't see why it would be any different in digital assets and in crypto. But in an efficient market, you should be able to provide that kind of those options for people to move in and out of these different opportunities.
I mean, Jürgen, where do you think tokenization is mostly running into obstacles at the minute? Is it regulation, like we're always hearing, or are there other obstacles that we haven't really considered yet?
Well, regulation is one side, but for some of the assets, I mean, there's structures in the traditional side as well, from a securities perspective, and many of these things can actually be translated over to the tokenization side. I mean, Germany has done that, Switzerland has done that, so you can take bits and pieces of that. I think what needs to be looked out for in the tokenization side is you need to see it holistically end-to-end for the lifecycle management, because it's not just you tokenize something and you put it on chain, but what are you doing with it, right? You need to create the liquidity, you need to create markets for it, you need to have a secondary market to trade it as well. That is all the things that actually should be at the forefront as well, and how do you build the smart context around it to call upon the different stages when you think about, shareholder votings, other, paying out dividends and so on. So, and this it comes more and more, but that hasn't really been taken into consideration. At least, when I look back, that's just not there. It was just about, we want to tokenize something, but why would you want to do that? Right? It's kind of like the thinking behind it.
And Morgan, how would you so that's one side of things, the market spread, trying to find liquidity for the markets of things that you're tokenizing. But you were mentioning earlier about real-world assets that you might tokenize that probably wouldn't fit into that bracket. Physical things like wine or art, or not all of it is kind of up for sale. Some of the time when you're tokenizing, it's for other purposes. What are the opportunities for those things being tokenized, and then what are the obstacles are they facing?
I mean, I think in general, by tokenizing things like wine, whiskey, other things, again, to the extent that it could be made like more of like a digitally native issuance, I think that's something that becomes like appealing for individual investors in terms of giving them an opportunity to invest in things that historically they haven't necessarily had direct access to. But I think whether you're talking about physical commodities or more traditional assets, I think one of the big challenges again is this question of distribution. I think a lot of initiatives initially started during the last crypto bull market, where I think a lot of people in the first instance thought just because you tokenize something, there's crypto capital that will inherently want to obviously buy this asset. And now that we're in a crypto bear market, people are realizing, that's not necessarily the case. So in my mind, the kind of exciting part of the holy grail is really when you're kind of on your Fidelity or your Schwab app and you're flipping through and you're seeing like equities, credit, and now you can invest in alts, and like that, in my mind, to the extent that you can kind of plug in a lot of these tokenization initiatives and projects into traditional Web 2, whatever you want to call it, distribution channels, that I think we'll start to really see kind of a pickup from a demand perspective, not because it's tokenized, but because it's a new asset class, whether it's wine or alts or whatever it is. But it's already integrated into forums and channels where people are already onboarded and already KYC'd, and they just now have a greater opportunity set from an investment perspective.
And I was just going to add, I think that's really important because there was a belief, and maybe there still is sometimes with people, that if you tokenize someone, suddenly it becomes really liquid.
Yeah.
And that's not the case. You can't magic up liquidity. But I think what tokenization can do, or what the technology can do, is unlock liquidity that's currently locked up. So you can kind of let things realize their natural liquidity where currently maybe you can't. But you can't just magic it up from anywhere.
Like a crappy asset is a crappy asset.
Well, yeah, whatever.
If you don't offer it, no one's going to have any. It needs to be there for people to buy it, right?
Yeah.
So.
Well, that's a good takeaway, I guess. We'll see what comes out in the next few years. Thanks for joining me, everybody.
Thanks
Thank
very
you.
much.
Thanks.
Thank you.